Those rare efforts of successful exploration will be richly rewarded. The average mine grade in my lifetime has decreased from about 2% to 0.4%. There are 1% or 1.5% discoveries out there waiting to be made. A true tier one discovery, a Marimaca, an Atex, a Kamoa Kakula, from a speculator's viewpoint, when they occur, will generate truly eye-popping profits for people.
During intense precious metals bull markets, attention gravitates almost exclusively toward the metals themselves. Headlines focus on spot prices, breakout levels, and psychological milestones, while the equity layer beneath the commodities often remains underappreciated. Yet history shows that the most extraordinary wealth creation in resource cycles does not come from owning the metal alone, but from owning the productive capacity and the rare discoveries that redefine supply. The market's fixation on price frequently obscures the structural leverage embedded in miners, developers, and high-risk exploration companies positioned correctly within the cycle. Rick Rule has spent more than 5 decades navigating precisely these dynamics. As one of the most experienced natural resource investors in the world, he has built and preserved capital through multiple commodity booms by focusing not merely on direction, but on valuation, probability, and asymmetry. In this discussion, Rule does not frame the opportunity as a simple metals thesis. Instead, he identifies specific areas: silver equities, high-quality oil producers, and copper miners, where arithmetic, underinvestment, and structural supply constraints converge to create unusually favorable setups for disciplined investors. Importantly, Rule remains constructive on precious metals over the long term. He views gold as permanent savings and silver as a powerful speculative instrument within the broader bull market. However, his emphasis now shifts toward where capital can compound most efficiently if prices merely hold or advance moderately. From silver miners re-rating under stronger margins, to oil producers generating high yields while sentiment remains cautious, to copper exploration successes that could produce outsized returns, Rule argues that the next phase of this resource cycle may reward equity owners more than metal holders. In this conversation, he explains why certain silver stocks could outperform even if silver pauses, why established oil majors and select Canadian producers offer durable cash flow leverage, and why copper, particularly existing permitted assets and rare new discoveries, may represent one of the most mispriced long-term opportunities in global markets. If you value disciplined, probability-based resource analysis rather than momentum narratives, be sure to like the video, subscribe, and turn on notifications. We appreciate the support and hope you enjoy the video.
Silver in my portfolio was in the speculative bucket. I save in gold, and I have since the year 2000. I maintain liquidity to pay my bills, make new investments, things like that, in US dollars. I speculated on silver. When silver was at $18, $20, social media, as an example, expressed total disgust for silver. Those people who could spell it, not many, hated it. And I thought that hate would dissipate. So I bought a fair bit of silver, or more specifically, I bought the Sprott Physical Silver Trust mostly. And I bought it as a speculation. I bought it because I thought the price could go from $20 to $50 when hate dissipated. I didn't need love. I just needed hate to dissipate. I bought it in anticipation of hate dissipating and the price going from 20 to 50. When that occurred, my reason to own the silver went away. I didn't own silver because I thought it could go to 200, although I don't doubt that it can. I owned it because I thought it would go to 50 or 60. And when it did, my reason to own it went away. Silver went up very far, very fast. And it went up in conjunction with a circumstance that you and I talked about in an earlier interview, which is when the generalist investor begins to trickle into the precious metals market, price leadership changes from gold to silver. That happened. So every speculative reason that I had to own silver occurred. Then I thought, in the near term, does the silver price have to go up from here? No, it's no longer hated. If the silver price maintains its current level for a year, by definition, I don't make any more money on silver. If it flatlines, my profits flatline. But if it maintains the current level for a year, the silver stocks, whose value is predicated on $40 or $45 silver, are up 50, 60, 100%. In other words, if the silver price doesn't move, doesn't rise, doesn't fall, it's likely that the silver stocks re-rate as a consequence of the cash flows that they generate, predicated on, say, $70 silver, as opposed to the $45 that current valuations suggest that they're valued at. So it became a better speculation for me to own the silver stocks than silver. Still a speculation, because in my own accounts, silver and silver stocks are the speculative edge of the precious metals bull market. I think in gold. And I didn't put all of the money into silver stocks. I put half of it into silver stocks. I put a quarter of it into physical gold. In other words, I took some money off the table, away from my speculative accounts, into my permanent accounts, which is to say savings. And I took 25% of the money and I put it in oil and gas, which I consider to be quasi-investment, quasi-speculation. I speculated gold stocks, but for the physical gold in my portfolio, it's there to maintain my purchasing power. For the record, I'm a fairly healthy 73-year-old, and I suspect that the sell decision with regards to my gold may very well be made by my estate after my demise, which I hope is a long time from now. But I regard gold as a core holding, a measure of liquidity that acts as an insurance against other forms of savings.
Okay. You mentioned that the portion of these funds from silver selling went to quality oil stocks. Are you comfortable naming them?
Sure. I think the bellwether oil stock is Exxon. Now, the first time you and I talked about Exxon wasn't that long ago. It was $105. At 150, I like it less than I liked it at 105. So in the near term, I suspect that the oil sector may be overbought. Investor concern, political concern about Venezuela, about Iran, about Russia has led to the oil quote recovering from $52, $53 up to $65. It wouldn't surprise me to see oil be soft in the 3 to 6 month time frame. So let's get that caveat in front of your listeners right now. The move I'm talking about is a 3 to 5 year move, not a 3 to 5 month move. But I bought quality. I bought Exxon. I bought a little bit of Chevron. I bought some Occidental, which I consider to be a speculation because they have a lousy balance sheet. And then I bought a basket of Canadian large cap and mid cap: Suncor, Canadian Natural, Freehold Royalty, Tourmaline, Birchcliff, Peyto, Arc. What else? I think that's it. Interestingly, the Canadian basket, taken as a whole, gives me a greater than 6% current yield, which is important if you think that the move that you're going to enjoy will occur 2 or 3 years from now. You take away the time value of money argument by high current yields. In the case of the companies I've named, those high current yields aren't coming at the expense of sustaining capital investments. These companies generate enough cash that they are able to make the sustaining capital investments necessary to maintain their production while distributing substantial cash to shareholders at oil prices that I think are substantially below the oil prices that we'll see 3 to 5 years from now. Right now with my money, Lucian, I need to say, I'm going to get more aggressive. I'm going to come way, way down the quality trail. And I'm going to buy some speculative juniors in maybe the last unloved natural resource sector in the planet.
Which one is that?
Conventional exploration, not shale. Offshore in frontier and emerging markets. That is to say, not U.S., not Canadian. I'm looking at very small companies, $30 to $50 million market cap, not generating free cash flow. Companies that have already enjoyed exploration success, that are looking to confirm that success in countries that are, that most people can neither spell nor pronounce. This sort of thing has served me very well in the past, where I take a sector that is stupidly out of favor, where each individual company represents the probability of failure. In other words, if I take 5 names, it's likely that 3 or 4 will fail. Not fail completely, but cost me 35 or 50% of my capital. But where one, if it works, can make me 20 to 1. In offshore exploration, where you already have indications of success and you employ good seismic technology, the probability of at least technical as opposed to economic success is somewhere between 25 and 33%. So statistically, I look at my portfolio. If I can generate 5 starts, each with a 25% probability of success, where the likely outcome in any individual circumstance is a 35% loss, but the outcome that accrues to a success is 20 to 1. You begin to see the math. With a 25% probability of success spread across 5 chances, statistically, the probability is that I will enjoy 1, maybe 2 successes. Those successes would almost certainly be 10 or 20 baggers, against the probability that most of my efforts will result in a 30, 35, or even 50% loss. Statistically, if you can afford financially and psychologically the loss, these are good bets. And in fact, Lucien, when I look back, all of the money that I now invest carefully, I made by speculating aggressively.
Rule's framework around silver is a study in capital efficiency. He initially approached silver as a speculation when sentiment was hostile and valuations reflected deep pessimism. As that pessimism dissipated and prices advanced rapidly, the opportunity shifted. The metal itself no longer required widespread disbelief to function. It had already repriced. At that stage of the cycle, the question becomes whether further gains depend solely on higher prices, or whether equity structures can deliver improved outcomes even in a flat pricing environment. In Rule's view, many silver producers are valued using conservative price assumptions that no longer reflect prevailing market realities. If silver merely sustains elevated levels, cash flows expand and valuation multiples adjust, producing returns independent of dramatic new highs. From there, his analysis broadens beyond precious metals. Oil, in his assessment, offers high-quality companies with current yields that compensate investors while they wait for a multi-year thesis to unfold. More aggressively, he turns toward conventional offshore exploration in frontier markets, a segment deeply out of favor, statistically risky, yet capable of delivering asymmetric outcomes when diversified properly. The common thread is probability mathematics, accepting small, manageable losses across several positions in pursuit of 1 or 2 outsized successes that can redefine overall portfolio performance.
Copper is both an investment and a speculation. I'm cognizant myself that the global economy is weaker than we think, and it wouldn't surprise me if copper didn't work for me for 2 years. In fact, it wouldn't surprise me if copper price and the copper stocks went down. I've been schooled in resources, sadly, not to think in 6-month or even 2-year terms, but rather to think in 5-year terms. And if you look 5 years forward, there is no way that the nominal price of copper won't be much higher, unless there's a synchronized global depression, in which case the price of copper will be the least of your concerns. I was in London not too long ago during mining week, and I listened to a wonderful presentation by Wood Mackenzie, where they described the intentions of the largest copper producers in the world, who said collectively that over 10 years, they need to invest a minimum of $250 billion US dollars to maintain current copper supplies. Copper's in deficit, and the demand for copper seems to be growing at 2.5% compounded. So, first of all, these major companies said that they understand where the first 100 billion is coming from, but they don't understand where the last 150 billion is coming from. In other words, of the 250 billion that they need to spend to maintain current production, they're missing 150 billion of it. The second thing is that maintaining current production isn't sufficient, given the fact that we're already in a structural deficit. The third thing is that copper demand is growing at 2.5% compounding. And it's not just AI. It's not just data centers. It's not just Teslas. 1 billion people on Earth have no access to primary electricity whatsoever. We're going to solve that problem over the next 20 years. It's going to take a ton of copper. 2 more problems on the supply side, Lucien, that your people need to understand. The first is that $250 billion is current dollars, not inflated dollars. An $8 billion bill for building a porphyry will next year be an $8.7 billion bill? And will the next year after that be a $10 billion bill? And the year after that will be an $11 billion bill.
Yeah.
Inflation is making newly installed capacity much more expensive than existing capacity. The second problem is government, as always. The increase in the take that government expect is increasing as the copper price increases. Always remember, the government's job is to steal, and they're much more efficient at that than you believe they are. A second problem around government is permitting. The best copper deposit in the U.S. is the Resolution deposit, 1.5 billion tons, a supergiant deposit, grading 1.5%, which is 3 times the average mine grade worldwide. That discovery has been in permitting for 28 years. 28 years. We have underinvested in copper exploration for 30 years, but if we stepped up exploration, by the way, it usually takes 10 years effort in a district to make a grassroots discovery. But if you assume then that it takes 10 years to make a new discovery and then 28 years to permit it, exploration expenditures now impact copper supplies 40 years from now, at which point in time the government may decide they want all the money. This means, from an investor's point of view, that existing installed permitted capacity, already paid for, with very long mine lives, is much more valuable than people think it is. You don't have to build something if you've already built it. You don't need to permit it if it's already permitted. The inflation in new capital construction doesn't apply to you because you have sunk costs as opposed to forward costs. So from the investment side of your portfolio, you need to understand that these assets are worth a hell of a lot more than the market thinks they are, because the market thinks in quarterly terms, not half decades.
Sure.
The second thing is that because we haven't explored for copper deposits, the pipeline to build is very, very, very constrained. Those rare efforts of successful exploration will be richly rewarded. The average mine grade in my lifetime has decreased from about 2% to 0.4%. There are 1% or 1.5% discoveries out there waiting to be made. A true tier 1 discovery, a Marimaca, an Atex, a Kamoa-Kakula, from a speculator's viewpoint, when they occur, will generate truly eye-popping profits for people. So for me, physical copper is of no interest to me. It's a fairly cheap commodity. It doesn't pay you to store it, particularly, unlike gold, silver, platinum, or palladium. But from an investment point of view, the means of production, very high quality, long-lived deposits, which are already producing, are cheap. And participating in successful efforts in copper exploration, you need to be very, very picky, will generate the type of returns for investors that exploration have in the past. But I think the returns are going to be on steroids in the next 10 years.
The most compelling long-term argument Rule presents, however, centers on copper. Unlike gold, which serves primarily as monetary insurance, or silver, which oscillates between monetary and industrial demand, copper is foundational to global electrification and industrial expansion. Structural deficits are already emerging, and the capital required simply to maintain current production runs into the hundreds of billions of dollars. Even more concerning is that a substantial portion of that required capital has no clear source. Inflation compounds the problem, raising the cost of new projects each year and widening the funding gap. Permitting and political constraints intensify the supply challenge. Major deposits can remain stalled for decades, and underinvestment in exploration has hollowed out the future project pipeline. When discovery cycles stretch across 10 years and permitting timelines extend beyond 20, supply decisions made today influence markets a generation from now. This structural rigidity dramatically increases the value of existing, permitted, long-life copper assets. Investors who own installed operating capacity effectively bypass inflation in construction costs and regulatory delays that plague new entrants. Yet the speculative upside lies in rare, high-grade discoveries. Average mine grades have declined steadily over the past several decades, meaning that a genuine Tier 1 discovery today carries exponential economic implications. In such cases, exploration success can produce returns that dwarf traditional investment outcomes. These opportunities are statistically infrequent, but when diversified thoughtfully across several attempts, the mathematics become compelling. A single major success can offset multiple controlled losses and still deliver exceptional overall returns. Within precious metals, similar dynamics apply. While gold continues to serve as monetary insurance and silver retains strong long-term potential, equity owners benefit from operational leverage. When costs are largely fixed and revenues rise with price, margins expand disproportionately. This leverage becomes especially powerful when valuations lag reality. In bull markets, re-rating phases often generate gains that exceed those of the underlying commodity itself. Taken together, Rule's thesis is not about chasing headlines or reacting to short-term price volatility. It is about recognizing where capital scarcity, underinvestment, and structural supply constraints intersect with improving demand. Whether in silver miners benefiting from higher realized prices, oil producers generating durable cash flow while sentiment remains cautious, or copper assets positioned at the center of global electrification, the opportunity lies in productive capacity and intelligent speculation. The metals bull market, in his view, is not ending. It is evolving. If you found this breakdown valuable, consider subscribing for more in-depth analysis on precious metals, energy, and resource equities. These cycles reward preparation, discipline, and a willingness to think beyond the headline price. Thank you for watching, and I'll see you in the next one.